Hi, everyone, and welcome to the Cruising Altitude podcast. This is COO and Senior Editor Ethan here with you today. And boy, do we have a great interview lined up. Today, our guest is Max Lucas. He is a petroleum engineer by trade, but now works in the banking industry and is the author of The New Investor, a book that hopes to teach a new generation of successful investors. Before we get into our interview today, we talked to the lawyers and we just have to get a quick disclaimer out of the way. Cruising Altitude is not a professional financial service. All materials released from Cruising Altitude are for educational and entertainment purposes only. Cruising Altitude is not a replacement for a professional's opinion. All opinions expressed on this podcast are our own. Members of Cruising Altitude and guests might have positions in the equities in the Cruising Altitude portfolio or mentioned in the newsletter or podcast. And with that, welcome, Max.
Hey, Ethan, good to be on.
Yeah, we really appreciate you being here with us today. So I guess, if you could tell the listeners, because they might be a little confused right now, how did you get from being a petroleum engineer to a career in banking?
Yeah, so I actually, graduated in petroleum engineering. Thought I was going to make a career working out in the oil patch. Had a job lined up working offshore Louisiana for Schlumberger, and then when COVID hit, my job was rescinded, and so I had to make a little bit of a pivot there. I was able to pivot, pretty successfully, obviously into finance. Now, just had a passion for finance, and then freak accident. The woman I was renting the house from with my girlfriend happened to work for a local bank, and I was able to get on in the wealth management division. And then recently here in December, I transitioned over into mortgages. So really liking it, really excited to be able to transition, was pretty passionate about the field before and was really happy that I was able to transition into a job.
Yeah, that's phenomenal. I know a lot of people had trouble during COVID, and it's amazing that you were able to use your skills to pivot into a different career field and a very interesting one, might I add.
Yeah.
So, something that you also did that isn't typical of petroleum engineers is you recently authored a book called The New Investor. So can you tell us a little bit about what's in the book, what's it about, its basic philosophy?
Yeah, for sure. So I in college was really excited about investing, got excited about it because of Robinhood, honestly. And a friend had told me it before I even started college, and in college got into investing more. And engineering actually surprisingly has a lot to do with investing. I mean, you're making financial decisions just with a scientific tilt to them, right? So it's not just what makes sense scientifically, but what makes sense on a budget. So I was excited to learn more about that in my classes in college, and I had people who were about to make huge money in engineering or in nursing, another program that the school offered, that had very little knowledge about investing, the greatest wealth generation generating product in the world. So I was excited to write a book that would be able to help people I graduated with learn more about investing.
Right, absolutely. And what sort of inspired your book? What was sort of the point where you were like, "Hey, I want to write a book on this concept"? Maybe even what gave you the confidence that you knew enough about finance to write a book for other people?
I don't think you ever really know enough about finance I think you can always learn more. And I don't think there was necessarily one time when I decided I knew enough to write a book. It was more that I felt I knew more than everyone around me in engineering, that I could help them out. I think finance, is another funny thing. Like you had said, with me transitioning from engineering into finance there, I didn't have to know everything to get into wealth management or then into mortgages. I just had a passion for it and was able to learn quickly enough. And that was the same with the book. It took me about a year and a half to write. I'd had an outline from the beginning, and there were parts of it I knew quite a bit about just from personal research and having worked in the industry a little bit now. But there was other parts I knew almost nothing about. The bond market, for example, was an area I just didn't know much about. But I was able to research it and at least write up enough that I was able to help a newer investor getting started.
Right. So you mentioned the newer investor there. So is that really who your book is targeted at? Would you say that there's a specific subset of the population that you really wrote the book for?
Yeah, so I definitely wrote it for people who aren't invested, right? I think that the amount of people who aren't invested in this country is really sad. I mean, the investments that you can make, especially in your early 20s, are life changing. If you have a 40-year time horizon, I don't care nearly as much about what companies you're invested in, even though we're both individual stock investors. But I care more about if you have a 40-year time horizon, you can make generational wealth. If you invest just a few $100s a month, you can be a millionaire in 40 years.
Wow, that is really powerful to think about. I guess it sort of goes back to the good old time value of money that everybody talks about so much in the finance world. So is that why, would you say that any college student should read it, even if they're not a finance major?
I would definitely say any college student should read it. I think that it's sad that in college, especially, a lot of people go into debt and don't realize that compounding works in both ways. If you start investing in college, the compounding effects over the next 40 year of your career are immense. And if you go into huge amounts of debt and don't realize maybe the burden that that debt is putting on you, that compounding works against you as well. So I think that any college grad or even college student or anyone going into college should really look at the book and look at compounding in that way. I know that before I went into engineering and really learned time value of money and present value, future values, I just didn't think of money the same way. I didn't think of money in terms of what it could be or what it was going to be. But now after writing a book and going through those classes, it's really easy to see that the best investors today are the youngest ones because you have the longest time horizon. If you want to extend your gains, just increase your time horizon. That's the best way to increase gains.
Right, absolutely. So if you had to take the single biggest takeaway from your book, which all the viewers and listeners should definitely read, uh, what would be the single biggest takeaway?
So I think the biggest takeaway from it is a concept I talk about that's a little bit controversial from the standpoint of it's not a practical extrapolation of rules, but it's I think a one that would it's necessary to look at. So one of the things I talk about in book is a decision tree. And in engineering, the way you make decisions is you bring all the project's future cash flows and you bring it down to a present value. And that tells you what decision I should go with, right? So if I look at an oil well and it has a potential of $1 million 10 years from now, and also has the potential of $5 million 10 years from now, or it has the potential of no money because we just don't hit oil, right? And I bring that all to present value, and I look at it's going to cost me $2.5 million to make, and it's going to be $3 million once I say that there's a 50% chance it hits, and it's 10 million. There's a 30% chance it hits, and it's only five. And then there's a 20% chance it doesn't hit. Well, if I bring all those numbers back into a present value, and I see that the project has a potential of $3 million from that, well, then I know it's a good project, and that's the one I'll go with. And the example I give with stocks is that there's no upside limit to a stock. There is no, this is the future potential number because a stock can go up infinitely. And
Right.
so I look at it as every investment I make can go down 100%, but it has no upside cap. And the real world example I get, because obviously, companies eventually have a cap, right? Amazon can only sell a widget to everyone.
Right.
I know companies like Google with a 90%, plus in search are really showing the potential of you eventually can run out of people to give a product to. But I give the example of Home Depot. He was up almost over 1 million%. I think it's about 1.4 million% before dividend reinvestment in the last 40 years. And for anyone who had invested over that 40 years, I mean, that's pretty much unbounded upside. So I give that example because if you're a new investor, if you're a young investor, particularly, you have the potential for unbounded upside with these companies. So just getting started invested in anything is better than not investing.
Yeah, absolutely. And I think you said that beautifully because, one of the biggest advantages that young people have is the amount of time that we have. And that's why we at Cruising Altitude have such a long-term focus because we know that if we make the right picks, and even if they're not the perfect picks, we still have the potential to accumulate a lot of wealth over the next 40, 50, 60, even longer than that years. So the next thing I kind of want to get into, stepping away from your book for a second, is your personal investment philosophy. So if you had to describe that, how would you describe your investment philosophy?
Yeah, so my own personal investment philosophy would be buy quality, hold quality, don't sell quality, and can do it for a very long time. I dollar cost average into my investments, so I don't try to time the market. I'm almost always 100% invested because I see holding cash as almost another way of timing the market. So I look at it as a company that I was buying throughout this whole time was a company called Lemonade. I'm sure it's one of them that's on your radar too, or at least heard about. And so I bought it, when it was close to $50 a share. I bought it when it got as high as 150 a share, and I'm still dollar cost and averaging into it when it's about 90 a share. So I don't necessarily care as much about the price per share or valuation. I mean, no one should care, especially in a time with fractional shares, what the price per share is. But I don't care as much about what the valuation is of a company that I feel is a great company. If I'm seeing it grow its top line revenue and I'm seeing it, produce for shareholders as far as management is, sticking to their goals and they're expanding their TAM, I look at that as a company over the next 10 years has potential to be better than it is today. And that's why I want to buy it.
Yeah, absolutely. That is extremely similar, if not identical, to Cruising Altitude's investment philosophy. So something that you mentioned there that a lot of viewers and listeners might not be really familiar with is dollar cost averaging. Can you kind of explain how that process works?
Yeah, so dollar cost averaging, I think, is a investment style that I think it doesn't get enough attention really. It's one that I think maybe isn't as flashy as others. And I also think that especially in our worlds, on Twitter, personal finance isn't talked about nearly as much as investing. I look at investing as a higher order of personal finance. When I worked in the financial planning industry, I was amazed really by how this whole time we've been talking about individual stocks and how to do due diligence and things like that. But for the majority of people, that it didn't really matter. I didn't, if I could have taught them one thing, it wouldn't have been, do I buy Home Depot versus Lowe's? It would have been, set up automatic transfers into your account,
Mhm.
right? Because that's going to do so much more for them than what company to buy would do. So dollar cost averaging is just every week or every, at a set time period, you're going to buy into a stock. So you're going to buy in, like I talked about with Lemonade. So every week, I'm going to put in, let's say, $10 into Lemonade. And if I continue to believe it's my highest conviction idea, I'm going to dollar cost average into it. And that means that I'm going to be buying it as it's going up, and I might be buying it on its way down. And, if I believe that it's on its way down because if it's a fundamental change in the business, well, that's one thing. But with Lemonade, it didn't necessarily go up on any particular news, and it hasn't necessarily gone down on any particular news. It's just been a broad sell-off in the market. And I think that this strategy would have been really, shown to do well in COVID times, because if you were dollar cost averaging into March and April and May, when you were buying great companies at really depressed valuations. I think the other way to really look at this is it's what you do in your 401k. Every month, I might pay periods of every month, but from, let's say every 2 weeks for most people, you're putting money into your 401k. And then when the market's doing good, you're buying. And when the market's doing bad, you're buying. And that way you kind of really do away with the psychology of it, of worrying about buying at what valuation or worrying about buying it when maybe the market's too hot or when you feel scared because the market's not doing very well.
Right. It's sort of the idea of the one decision that eliminates a bunch of future decisions. So you're making that one decision that this is the stock I want, and you're going to buy it pretty much at any price. And
Mhm.
the way you have that set up, is this something that you're going and doing physically? You go on your phone and your computer and you're making those purchases, or is it an automated process? Because I know that there are different ways that you can do this.
Yeah, so for me, it's pretty much an automated process. I know I have my different accounts. My 401k is in a target date fund, and so that's automatically bought that target date fund every month. I have other accounts that are in, ETFs that I'm buying. I have an ETF for, future goals, and one for kind of my own venture capital fund, if you will. Just, going to buy a privately held company. Not a big one, but just a private venture. A target date, I guess, for that. That's just in an ETF. But then I have my Roth, which is an individual stocks. And for that one, I have $100 there, whatever. It's like 120 something to get the 6K, max for the Roth there, going in every week. And I'm just buying my highest conviction stock or the stock that I don't feel like I have enough exposure to. So Lemonade was that stock for a while, and I'll split it up between a few stocks, especially now with fractional shares. It's easier
Right.
than ever to invest, as little as $10 or $5 into a company that I feel like I just want a little bit more exposure to.
Yeah, absolutely. I think you did a great job of explaining that. So now I kind of want to go into a bit of a rapid fire round. So I want to ask you how you feel about different things in the world of finance. So this is going to be a wide range of topics, and maybe just give me 30 seconds to a minute about how you feel about each financial topic and sort of where you see it ending up. Maybe a year from now, maybe 10 years from now, whatever time horizon works for you. So first up on our list, SPACs, or special purpose acquisition companies.
Yeah, so SPACs obviously been knocked down quite a bit here in recent days. I think they got, I think saying that SPACs are in a bubble is maybe a misnomer because I think, it's just a different way to come public. That would be like saying IPOs are in a bubble, right?
Mhm.
I mean, might the IPO market be getting hot? Sure, but I don't think SPACs themselves are in a bubble. But yeah, I think SPACs, I look at it as just a different way to come public. Once the company has come public and is publicly traded, it's no longer a SPAC, Virgin Galactic, right? They have to report like every other company. It's not like you get special treatment just because it came public via SPAC. I think if you're investing in it pre-deal, you're a little bit more of a gambler versus if you're
Right.
investing in it post-deal. So
Absolutely. Next up on our list, NFTs or non-fungible tokens.
yeah, so NFTs, I really like NFTs. I think the possibility for them to make artists, be able to quantify their work in a dollar figure is just really interesting. I think that the tax implications of most art today is being held in free ports where it's not actually displayed. It's
Right.
an investment, right? You're holding it and you bought it for 10 million. And the idea is you're gonna be able to sell it for 20. So I think that's similar to NFTs. So I look at it as more liquid art, which I think if you bring liquidity to a market, that's a good potential there. I think again, though, who knows what they're going to do in 5, 10 years. I think for the average person, it's just more exciting to watch rather than be involved in.
Right. And is that something that you would personally get involved in? Would you want to own a virtual image that anyone in the world theoretically could access at any time just to say that you own it?
It's funny. I actually tried to get involved with NFTs. I made an NFT of my book cover, and
Really?
I'm currently trying to get it listed. So if anyone wants to buy an NFT, I have a book cover of my book as a non-fungible token out there, so they can contact me.
That is very cool. And I've heard of a lot of different people really capitalizing on this opportunity. And I think it's a really interesting market. I'm not sure if I'm going to get in now or ever, but right now I'm pretty much just watching it. And I think that the entire cryptocurrency space is really interesting. The entire blockchain space is really interesting technology. And it's probably going to be very prevalent over the next 5, 10 years and well beyond that.
For what it's worth, I do think blockchain's a lot more exciting than NFTs or Bitcoin. So I think that might also have my stance on it there.
Yeah, I would agree with that. I think that there are a lot of potentials uh, for a lot of potential uses for the blockchain, especially in the world of finance.
Yeah, for sure.
Uh, so this next one is a recent event that took place. How do you feel about the collapse of Archegos? I'm not sure if I said that right. It might be Archegos. Uh, I guess first of all, how do you pronounce it? And second of all, what do you think of it?
Yeah, I pronounce it Archegos. I've heard Archegos, however people want to pronounce it. They probably know what we're talking about now. Or if they don't, they wouldn't know it, depending on how we talked about or how we pronounced it anyway. But yeah, I think honestly, the story of Archegos, there's a lot of regulatory things with Dodd-Frank and it not being regulated the same as other hedge funds because it's a family office. But I think really the story around there is what leverage can do to a portfolio. I
Mhm.
think I had heard reports that they were about 5 to 1 levered, which I think that's a great lesson for individual investors on why you don't trade on margin and why you don't short companies, because if you're levered, your ability to withstand risk is a lot less than if you're not levered. So I think that's just a great example of why you don't take on leverage and why you don't trade on margin and why you don't short companies.
Yeah, absolutely. I think that that's there are a lot of lessons that can be learned from this, and I guess we'll kind of see what comes out of it regulatory wise. I think that there are going to be some changes made after this. And I actually heard some things that said Archegos might have been levered up to 20 to 1. So they were taking on, for those of you who might not be super familiar with the incident, they were taking on a lot of levered bets, which means using debt to make purchases of stocks, equities with money that they didn't have, so that when the value of the stocks went down a certain amount, that exceeded the amount of actual cash that they had. And then the different banks came in and said, hey, we're going to do a margin call. And we explained what that process is and how that works in a previous Cruising Altitude newsletter. So feel free to check that out for a bit more information on the incident. And
Then
another,
also too, if sorry to interrupt there, but yeah, another if obviously I'm sure us younger people, probably haven't seen as much, but the movie Trading Places is
yes,
a great movie to if you want to
thank
see
you.
what a margin call looks like.
Yeah, excellent movie. I love that reference right there.
Yeah.
And if you guys haven't seen Trading Places, definitely go watch the movie. Uh, but another aspect of the Archegos incident is that a stock that is very near and dear to Cruising Altitude's heart, Viacom CBS, had a big downfall up from over $100 down to the 40s in less than a week. So, how do you look at that opportunity? Would you say has this changed your outlook on Viacom CBS specifically? Because some people who are bullish on it might see it as sort of a stock that's on sale right now.
Mhm. Yeah, I mean, personally, I haven't done enough looking into Viacom CBS to know, personally what an opinion on it. Um,
Absolutely.
so I would defer to you, I guess, on that one. I know I'd seen you on another podcast or Alan Sokloff there on another podcast talking about it. So I'm gonna defer to you guys as the experts on if it's a buying opportunity or not.
Yeah, absolutely. And for the viewers and listeners out there, we also wrote about why we still believe in Viacom CBS in our last Cruising Altitude newsletter. So check that out for more details there. The next thing that I want to ask you how you feel about is the GameStop incident. That was back in January, I believe.
Yeah, so GameStop obviously a well-known company now, and I'm sure well-known stock now, I should say. Probably the company is a lot less known than the stock is.
Mhm.
Probably they should just change their name to GME at this point.
Yeah,
But I think the stock, it had over 100% short position on it there. So I think that the people who initially had made the bet that it was going to, have a short squeeze at over 100% short position, that's a good fundamental trade, if you will. I known a lot of smart investors who saw that as a potential. The cash flow was there, it wasn't going to zero, and the short position on it had it, bet on it like it was. And so I see it as at $1 billion company with 140 some percent short position, that's a good trade. It's not a good investment. I don't think GameStop will become the Netflix of video games because I don't think the publishers would allow it to be.
right.
There's just no reason that Activision Blizzard or Nintendo would let GameStop be their sole distributor. But I do see it as, if you made that trade, good for you. And I look at the valuation now, though, as it seems like it's more of a political statement, if you will,
Yeah,
against Wall Street than it is an actual investment. And I hope people, are doing due diligence, and I hope people don't look at investing as a political statement. I think you can invest your conscience, but I really hope that people are treating investing as a means to wealth versus a political statement. But investing is, for whatever people they want it to be. So if it's their money, if they want to put it on GameStop and let it go up and down and casinos are closed, more power to them, I guess. At least they're, I think the hardest job, which kind of gets into our next topic thing on Robinhood, but I think the hardest move, if you will, is to get started investing. And so if you're already set up with the account, I think the transition to long-term investor versus trader is easier than the transition from not investing to investing.
yeah, absolutely. And you made the transition there perfectly. It seems that sort of the gateway to investing these days is Robinhood. I think that's the most popular sort of commission-free trading app right now, or at least one of the most popular. So, how do you feel about Robinhood? Maybe how you feel about the commission-free trades, how you feel about the gamification, and how you feel about the people who are I guess, using Robinhood to day trade.
Yeah, so I think Robinhood's an interesting story. I personally I like it just from the perspective of that's how I got started investing. If it wasn't for Robinhood, And it was, at the time when I started, everywhere else was $7 a trade or $7.99 a trade.
Right.
And I started with probably less than $500. And so if I had to pay $8 a trade to learn the lessons I did early on, and not buying penny stocks, and actually doing due diligence, and if I see a dividend yield of 20%, that's not a guaranteed 20%. There's probably something wrong with the stock.
Right.
And so those lessons I was able to learn were free. And so the being able to learn a lesson in real life and not just learning it because someone told you do this or do that is so crucial. And so I look at Robinhood as, if they're getting more people to invest or just to be involved in the market, I look at that as a plus. I mean, even when it was going on, everyone was against Robinhood and people were talking about how bad Robinhood was. I
Mhm.
think downloads of it were up like 3 times.
Yeah.
It was the highest downloaded app, I think, at the time. And so I just look at that as great. If people are getting involved with it for the wrong reasons, I look at that as still better than people not get involved with it at all.
Yeah, I think that I completely agree with that. I think that Robinhood has offered opportunities to people who wouldn't traditionally be invested in the stock market. And the fact that they have the commission free trades really helps a lot of people to make the trades that they want to make. I just think that it's important to pair Robinhood with a long term investing mindset. But I don't think that there's anything inherently wrong with Robinhood that makes it anti long term investors.
True. I think that there's also credible complaints against Robinhood that they encourage trading because,
Mhm.
one, that's how they're monetarily incentivized.
Right.
They give you balloons and things like that that encourage trading. So, I mean, personally, I left the platform a few years back. I went to E-Trade and then
Mhm.
recently Fidelity. And I think Fidelity is a much better platform, but it's also just a little bit more cumbersome. It's not as easy to, if you don't know what you're doing, to get started on.
Right.
And for that, I really enjoy Robinhood. But for most people, I think that if you have some idea of what you're doing in the market, there's better platforms out there for you than Robinhood.
Definitely. Like I said, kind of a few minutes ago, I think it's a great gateway into the investing market.
Mhm.
And the last, how do you feel about this of the podcast? How do you feel about the possibility that we're in a stock market bubble right now and that it might pop?
Yeah, so I think one thing with stock market bubbles is that they're never in one sector, right? It's always something that's going to pop. So I think if you are going to say we're in a bubble, my next question would be where, right? So the first one, if we look back to 2008, which is not the first bubble, but the more recent bubble, is it was a bubble in housing and finance, right? Because finance
Right.
being on the hook for the housing. And so if you were in all finance and housing stocks, well, you probably got killed. But there was other stocks that performed well, and got dragged down initially in a whole market downturn, similarly to here in 2020 when COVID hit. But there's other stocks that did great. I mean, Zoom Video bounced back, no problem. I think the Trade Desk one initially that got slaughtered, I was up over 800% in after it bounced back. And so I think that it's really important to notice that just because certain sectors might have gotten heated doesn't mean that the whole stock market is in a bubble. So, and also just because the economy is ran doesn't mean that the stock market is in a bubble. I think that you got to look at some macro factors too to look at if we're in necessarily a bubble or not. One of the macro factors being that interest rates are at zero, right?
Right.
If our long-term interest rates are at zero, well, then it's hard to say what a company's future cash flows can be if they can borrow money at unheard of interest rates. And they can fund so much growth that it's hard to say what they can do in the future.
Yeah, absolutely. And you know, a lot smarter people than me have debated whether or not we're in a bubble right now. So I guess the conversation will continue to go on. And sort of the final thing that I want to do here on this episode of the podcast is what is your final takeaway? So if the viewers and the listeners remember one thing from this podcast, what should it be?
I think if the viewers and listeners can remember anything from this, I would say just stay invested. There's a lot of talk about, what stocks will be good, what markets will be good, if we're in a bubble or not, if there's this investment versus that investment. But the number one thing you can do to increase your long-term wealth is to stay invested and continue investing. Set up automatic transfers and just continue investing. it's much more important that you're investing rather than what you're investing in, especially when you're young, especially if you're under, like, let's say 30 years old. It's much more important that you just stay invested, because either A, you're going to create generational wealth, or B, you're going to learn some great lessons at money that's nowhere near what your long-term wealth will be.
Yeah, absolutely. I 100% agree with that. Stay invested, everybody. So you have been an excellent guest, Max. I really want to thank you for your time and for coming on the Cruising Altitude podcast. Where can the viewers and listeners find you on Twitter and other social media?
Yes, so I'm at Twitter at invest_book. And then you can find my book. There's a link to it on my Twitter. And then I also run a website, New Investor Nation. And so if you just look up newinvestornation.com, you'll find me there.
Great. Thank you so much. And as always, you can find Cruising Altitude on Twitter at CA30K, or you can subscribe to our newsletter at cruisingaltitude.substack.com. And I'll make sure to put all these links in the description of the podcast and the YouTube video. But thank you again, Max. And that's it for this week's episode.